If you're a value shopper who compares grocery prices in your local supermarket, then you already have the right idea when it comes to being a value shopper for stocks in the stock market. When you compare grocery prices, you don't simply compare the item prices and choose the cheapest one. You look for items that meet your requirements, and when you find similar items that you like, you compare the price to weight or price to volume ratios to choose the best value. You may actually choose the more expensive item as the better value. While you may not have heard of the price to weight or price to volume ratios, this is exactly what you're using when you compare the price per pound or price per gallon of two items. You compare these multiples because while a 12-ounce item at $7.20 may be cheaper than a 16-ounce item at $8, the 50-cent price per ounce of the larger item compared to the 60-cent price per ounce of the smaller item makes the more expensive item the better value. As a value shopper, you want to make a similar comparison for stocks that you're buying in the stock market. After you've determined that you want to add a certain type of stock to diversify your portfolio, you compare the price multiples of similar stocks to determine the best value. However, stock price multiples are not based on weight or volume, they're based on earnings. You compare price to earnings multiples to evaluate similar stocks because you know that comparing the $80 share price of Facebook to the $130 share price of Apple may not help you determine the best value. Even though the share price of Facebook is less than the share price of Apple, the 17 price to earnings ratio of Apple may represent a better value than the 71 price to earnings ratio of Facebook. There are several different price to earnings multiples that you can use to compare stocks. You'll want to do your own homework to learn more about these and other stock metrics. The common metrics are the trailing price to earnings ratio, commonly referred to simply as the PE, the forward price to earnings ratio, commonly referred to as the forward PE, and the price to earnings to growth ratio, commonly referred to as the PEG ratio. The PE is calculated by dividing the current share price by the earnings per share for the previous year. The forward PE is calculated by dividing the current share price by the estimated earnings per share for the coming year. And the PEG ratio is calculated by dividing the PE by the projected earnings growth rate. So now you may be asking yourself, what is a good PE or a good PEG ratio? Well, what is a good price per pound for ground beef? Stock valuation, like grocery valuation, is relative. Stock valuations make the most sense when you're comparing the relative valuations of similar stocks in the same sector. Furthermore, you can define a fair value range for stocks by comparing them to the averages of S&P 500 stocks. The average PE over time of the S&P 500 is approximately 15, and the present-day average PE of the S&P 500 is approximately 19. For the PEG ratio, it's common to rate stocks with a PEG ratio below 1.0 as undervalued. For this illustration, we'll establish our fair value PE range as 12 to 18, and our fair value PEG range as 1.0 to 2.0. Once we've defined our fair value range in terms of PE and PEG ratios, we can look for bargains in stocks valued below our fair value range, and we may consider selling stocks valued above our fair value range. We would consider holding stocks that are in our fair value range. When we're looking for bargains and we find multiple stocks that meet our selection criteria, we'll compare the price multiples of these stocks to select the best value. These metrics are only guidelines, so any stock valuations that pique your interest should be followed by homework before you make any decisions. You will learn to adjust these and other metrics based on your risk tolerance and your appetite for dividends in addition to share price growth. Let's look at a real example to illustrate relative stock valuation. We're using Ticker Toolkit Deluxe Edition to do our stock investment homework. You can download a free 30-day trial of Ticker Toolkit at www.tickertoolkit.com. We define our fair value range by setting Ticker Toolkit's lower and upper evaluation thresholds, where the lower threshold is the lower end of our fair value range, and the upper threshold is the upper end of our fair value range. One nice thing about Ticker Toolkit is that it color codes our stock metrics, so that values below our lower thresholds will be green, and values above our upper thresholds will be red. As a stock investor, whether it's your self-managed brokerage account or an investment account managed for you, you should have a stock workbook that contains a page for each of your stock investment accounts and pages for each stock category that is of interest to you. Stock categories, commonly referred to as sectors, include stocks for consumer, financial, healthcare, industrial, and other company categories. On each sector data sheet in your workbook, you'll list the stocks in that category that you're watching. If we want to consider technology stocks for possible addition to our portfolio, we need a technology sector data sheet in our workbook. We'll add our technology sector data sheet using the Ticker Toolkit control panel. Then we'll add Apple and Facebook to the technology data sheet. Then we'll click Update to retrieve the latest information about our stocks. When we compare the price-to-earnings multiples of Apple and Facebook, we see that Apple appears to be a better value on all counts. The PE, the forward PE, and the PEG ratio of Apple are all lower than the price-to-earnings multiples of Facebook, so at first glance it does appear that Apple stock is a better value. With Ticker Toolkit, we can continue our stock homework by clicking on our customized hyperlinks to compare commentary from our preferred stock information sources. For example, we see that Zacks rates Apple as a 2, while Zacks rates Facebook a 3. Ticker Toolkit allows us to easily switch to one of our other trusted information sources to view additional analyst commentary. We see that Motley Fool also favors Apple over Facebook. Based on this quick assessment, our metrics and our trusted analysts indicate that Apple is the better value. You can follow other technology stocks simply by adding them to the technology data sheet in your workbook. Over time, you will build your stock workbook by continuing to add stocks as we have done here and comparing them based on their relative valuations. If you want to try this for yourself, download Ticker Toolkit at www.tickertoolkit.com and try it free for 30 days.